listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. Have another great guest with me today. This man really needs no introduction to resource investors and probably 98% of listeners. He is Rick Rule. You can find his new venture at ruleinvestmentmedia.com. He has a resource symposium going on in July, which we'll get to at the end of this interview. But Rick, I want to get right into it. I have several specific questions for you. The first one is, so the majority of gold and silver companies right now, they're trading well off their highs. How can we distinguish between, within that group, the quality companies that have real prospects and some value versus the companies that basically don't have any value?
Well, this is a very long topic, but I'll do my best to keep it within the confines of the interview. I start my screening of companies by people. I have found that performance doesn't segregate equally, which is to say performance concentrates. And so when I begin looking at companies, if they have been referred into me by someone who I know well, or if someone who I know very well is affiliated with the company, let's say a Ross Beatty or the third generation of the Lundins, I'm inclined to look more closely. You know the phrase, luck favors the trained observer, or more importantly, Pareto's law, which suggests that 20% of market participants generate 80% of the utility, and that 20% of the 20 segregates along the same performance dispersal curve. That tells you that the first stop is people. But I look too for what I would call scale. Too often when people look for a small mine, unfortunately, they succeed. And a small mine has all the risks of a big mine, but can never make you the same amount of money, big money. So I'm looking for recoverable reserves in the gold business, at least in excess of 1 million ounces. I'm looking really for in situ recoverable mineralization, minimally in the $2 to $3 billion range, more preferably in the $10 billion range. I'm looking too for companies where their disclosure meets certain standards. I like websites that give me the ability to understand the deposit. I'm not looking for screaming headlines. I don't seem to be able to buy or sell screaming headlines. I am looking for companies that have good deposits, that report those deposits intelligently. And I'm looking for companies that exhibit some scale. More particularly in the junior mining companies, I am looking for companies that are at least fairly valued. I don't want to pay too much of a step up. So I'm looking at a risk-adjusted net present value, hopefully off of at least a preliminary economic assessment. But if not, with enough drilling and deposit data that I myself can come up with a risk-adjusted net present value valuation within a sort of an approximate range. I'm looking too for whatever the important unanswered questions are with the deposit. I'm looking for a situation where I can expect, in my own mind, the probability of an 18-month double. So I'm looking for companies where their exploration programs will add more certainty to the valuation of their reserves in a way that can give me a reasonable double. And certainly in an exploration stock, I'm looking at the possibility, however distant, that within 5 years, I could have a 10-bagger. That isn't to say, Jordan, that every investment I make gives me an 18-month double or a 5-year 10-bagger. But I understand certainly that most of my decisions will result in small losses, and my wins have to amortize my losers. And the question, that circumstance demands that I pay a fair price for the existing asset, that I have the prospect of a catalyst in hand, and that I have an upside that will allow me to amortize my failures against that success. I need to tell you that I'm commodity agnostic. While I feel good about gold and silver, particularly at these prices at this point in time, I'm happy to make money on sand and gravel. Somebody doesn't need to come to me with the commodity du jour of the moment. In fact, I am more in favor of out of favor commodities than I am in favor commodities. And I am also, unlike probably many of your guests, how would you say, more flexible with regards to political risk. I have learned that the most dangerous government to me is the government closest to me. So while many of your listeners might favor a U.S. jurisdiction or a Canadian jurisdiction and pay a lot for that supposed safety, I need to tell you that the worst experience of political risk that I ever enjoyed, if that's the right phrase, was in the People's Republic of California, where I then lived. So I am much more inclined than other investors to take the Congolese risk, to take the Bolivian risk. So I hope that summary helps.
No, that's really fantastic. One follow-up on that, because I know you're a value investor and a value speculator, as you know, most great investors are. Is there a point, or tell me a point when it would actually make sense to buy I don't want to say an overvalued, but maybe a strong resource stock that, you know, they have a really good discovery, or maybe it's a producer and they're doing really well. Maybe it's a little, you know, it's not a value, maybe it's a little expensive, but you know, there's real potential for it to do even better. I mean, is there a scenario where you just look at that and say, geez, I think like this is really has world-class potential, and I don't see it getting any cheaper, and I see it getting way more expensive? Like, is there any instance where you would actually put, you know, you even add to your position in something like that?
The best investments are always statistically overvalued compared to the mean, because the people are better and the deposits are better. In the very near term, the market is a voting machine, not a weighing machine. It's a popularity contest. And often people don't value good deposits and good people highly enough. One example, and this is not a stock recommendation, but I've been an investor in Reunion Gold, a Canadian issuer active in the northern part of South America for some time. I've got more than a double in the stock. I saw the release today. I'm a buyer. If the market gives me an excuse to buy more, I will certainly do it. So, you know, it's really data dependent with me. Every time I buy a stock, I have a little piece of paper that I write down my thesis on, why I bought it, what I think the near-term catalysts are, what would cause me to buy more, what would cause me to sell. Now, over time, as data comes in, that little piece of paper I have obviously changes. But let's look at a circumstance. Let's say that I bought a stock and I believe that there's a probability that I have a 12 to 18 month double in the stock for 2 or 3 reasons. There are 2 outcomes there. They can deliver on fundamentals, or they can't. If they can't, my reason to own the stock disappeared, and the stock has to disappear, irrespective of price. If I bought a stock at $1 because I thought it was going to go to $2 because they were going to do X, Y, Z, and they didn't do X, Y, Z, I don't care if that stock's at $1, at $1.25, or 50 cents. If my reason to own the stock goes away, the stock goes away. No ifs, ands, or buts. It gets a little more complex if they do deliver. If they deliver, and I think they're worth $2, and they're still selling at $1, I've already done the intellectual work. I buy a bunch more. If they've delivered and the stock has gone from $1 to $2, I ask myself the same question. Is there another unanswered question that within 12 to 18 months will cause the stock to double again? Or is the stock fully valued? If the data points to door A, which is to say that the unanswered questions that they've answered provoke more unanswered questions, and it's likely that I will enjoy another double, I stay with the stock, or maybe even buy more. If I believe that the stock is fully priced, and I can't describe for myself fully what the value proposition is for the next 12 to 18 months, I sell the stock.
Okay, great. And so, I mean, this is also a follow-up because I think you touched on this to a degree, but so with respect to when you determine you need to sell an exploration company, so it's entirely dependent on your thesis and they're not hitting certain marks
Correct.
or objectives. Okay.
Absolutely.
So
Or importantly, if they lie to me. I try when I interview companies to give them the opportunity to lie to me. I try to give them the opportunity to misinform me. Because if they do that, they save me a lot of time. I throw them away. I never talk to them again. And I never disgrace my portfolio with their names so that I can lavish more love and attention on honest people and not spend time with dishonest people. If I can't trust the information, I won't own the stock.
So, and I mean, I don't want to duplicate the question, but when can you conclude that something has failed or has no potential anymore versus something that's really struggling that could be a good opportunity? I'm trying to distinguish because, in your career, you've probably seen companies that, maybe they have a couple great drill holes. It looks really good. And then the stock comes down and does nothing for a couple years. And then suddenly they find what they're looking for. I mean, how can you distinguish between like that, the potential for that type of situation versus the potential for the company, they just drilled one really good hole and that, stock goes way up, then it goes back down, but it really has nothing.
Well,
I mean, I know it's a tough question, but how do you distinguish between those two?
Let's do a scenario. Let's say there's a company with a $2 million market cap. They have an interesting project. The only data that they have on it really is geological interpretation and some surface samples, but the surface samples are widely spaced. There's the potential for a very, very big target. The unanswered question may be, is this transported gold or does it go from depth? And the method by which they propose to test that thesis might be a widespread trenching sample to see if the mineralization that they see on surface extends to bedrock. So the first unanswered question is there the beginnings of a third dimension? Do we have a drill target here? So let's just say for fun that they throw 20 trenches in the thing, and they prove that the deposit goes from unconsolidated into consolidated material, which is to say they have a legitimate drill target. So far, so good. If that trenching program worked and legitimizes the target, I'll stay in place. If, despite the fact that they've delivered good data, the stock falls, I'll buy more. I love to be right when I think the market is wrong, and it's happened a surprising number of times in bad markets. So let's say that happens. Let's say now that they want to test the third dimension. They want to test the thing to depth. And they propose a series of 10 drill holes to check the third dimension, but also test strike and width. And let's say from my viewpoint that I need a coherent core of at least 5 or 6 drill holes to demonstrate a target that has the potential to be economic, not disjointed, not lenticular, but rather mineable. If I get that core of drill holes, and if we've proven the third dimension, which is to say there's depth, and it looks like the target has the potential to be an economic deposit of scale, I'm happy to hold the stock. If by contrast, 3 of the 10 holes hit, or worse yet, none of them hit, and it looks like there's absolutely no probability based on the drill hole defining an economic deposit, I'm gone, irrespective of the share price. So let's say, just for fun, that in this 10-hole program, 7 holes have hit. I'm beginning to see the outlines of the deposit. The new work program might be to look for extensions based on the information drilled from the 7, but more importantly, to begin to delineate the deposit as to potential tonnage and grade. And let's say now, up from 7 successful hits, that they have a 30 drill hole delineation program. This is something that is in anticipation of a PEA. To the extent that the delineation program proves up consistent mineralization, potentially economic with regards to tonnage, grade, and lie, then I continue to be interested. It really is an ongoing process that goes just like that. I look at what the unanswered question is. I look at the answer. I look at the question proposed by that answer, and I try and estimate valuation along the way.
Okay, great.
That's very different than most people's technique, which has got a hunch, bet a bunch.
No, absolutely. How does your investing and speculation strategy change, if at all, during, let's say, a real bull market like the 1970s bull market or the bull market that we had in the 2000s, where you see consistent higher highs in gold and silver prices or other commodities? I mean, you're such a value investor. I mean, are you more of a seller, or
Yeah, much
are
more
you
of a
just
seller. Much more of a seller. I work on absolute valuations. And when I do valuations, I understand that I'm always wrong. I never get it right. So I try and construct myself a valuation metric, or matrix, I guess I should say. At $2,000 gold, I might construct a $2,500 case to inform me as to optionality. I'll construct a $2,000 case to give me a net present value case. And I'll construct a $1,500 case to give myself a downside case. And I look at the sum, if you will, of those. If I have a big deposit, I'm inclined to be a little generous on the price, because the benefits I've gotten over the last 50 years from optionality, which is to say large deposits in a rising gold market, has fueled my greed. I'm willing to take a bit more risk if the size of the prize is, as an example, 10 or 15 billion dollars in situ recoverable resource. By contrast, if the deposit hovers around my minimum, which is to say 1 million ounces of gold equivalent, I'm much more inclined to do prospective net present value calculations at a discount to the current gold price. What happens is that in bull markets, where people's expectation of the future is shaped by their experience in the immediate past, and that experience is good, that is to say, when the market is consistently overpaying for product, I'm usually a seller, because I work on my estimate of absolute valuations. In those circumstances, I reduce my exposure to the market, but I take more risk with it. I go for earlier stage circumstances, often non-public startups, with people who I know very well, who can get to market because their cost of capital, and hence my cost of capital as an early stage investor, has gone down. Investments that you make too late in a bull cycle always end up costing you at least half your money. When the market, or your intention to take advantage of the market, causes your greed to overwhelm your fear, you will always be punished. That's the iron law of speculation, and my experience has proved no exception.
When you sell, do you just start by selling, a third or a half, or do you just sell everything in one blob?
I tend to buy big and sell big. In bear markets where there isn't much liquidity, it might be that my intention is to own 5% of the company, but I'm unable to do it on a timely basis, so I have to nibble in. If I want to sell a company, I tend to be pretty aggressive.
Yeah, another follow-up for you, because I know you're so big on people, but I mean, at some, Ross Beatty, there was a point where he wasn't Ross Beatty, and then he had all this incredible success. And that it's not just these big names who have successes. So how can you find the Ross Beattys who aren't at that level right now? Because there's a lot. There is some luck involved in making these. There's a lot of science, but there's also a lot of luck involved in making these discoveries. So how can you find a good group or a good person to give your money to when they don't have the record of a Ross Beatty?
It's both easier and more difficult for me now. More difficult because I'm older and I'm unable to work as hard as I could when I was young. I ran into Ross Beatty because he had just an astonishing reputation, in the exploration community. I invested in his first deal pre-public, I'm going to say in 1984, having known Ross since university. I was able, in my 20s, to get to know Ross well, to get to know Bob Quartermain well, to get to know the Lundins well, to get to know Robert Friedland well, to get to know a whole bunch of people who became standard bearers in the industry. Now, I'm not able to circulate as broadly, but mercifully, I have hundreds more contacts than I had then and a much broader reputation. So I'm able to see sort of 10 inbound submittals a day. And importantly, I'm able to vet the submittals by who sent them to me. There are people who have sent me product that I've been able to buy for a very long time. An example would be Bob Quartermain. I've invested in his 3 issuances in 30 years. But importantly, about once every 5 years, he gives me an idea that's run by somebody else. At least 3 of the third-party ideas that Bob Quartermain has sent me have been 10-baggers. So that's what I try to do. I, not so recently, but maybe 2 years ago, invested in Zach Flood's deal, Kennerland. I've known Zach since he was a teenager because I did so much business with his dad, Ed Flood. So that's sort of what happens.
Okay, and wrapping things up, Rick, why don't you tell us about your symposium that's coming up next month? Why should resource investors attend this conference?
I will humbly submit that the Natural Resources Investment Symposium for natural resources or precious metals investor is the single finest investment symposium on the planet. I have run it myself for 21 years, but it's in its 30th year of existence, so it has stood the test of time. How has it done that? Well, in the first instance, we spare no expense in gurus, the big picture thinkers, the Bill Bonners, the Doug Caseys, the Jim Grants, the Grant Williams, the Jim Rickards, people who have a point of view that has stood the test of time and is unique. These aren't the gurus that you'll see on CBC or CNBC, but they represent an important worldview if you are interested in natural resources and precious metals. If you accept that worldview, we try to bring the finest portfolio managers and analysts that we can find to bear, people who are 20 and 30-year veterans, people who have done well in good markets and bad. The idea being that if you accept the big picture view, you need to implement it, and you need professional help in implementing it. Importantly, Jordan, every issuer exhibitor at our conference is owned in an account owned or managed by myself, which is to say every single exhibitor at the conference has been vetted. There's unfortunately no guarantee that because I own the stock, it goes up. But there is a guarantee that these exhibitors have enough going for them that I've invested my time and treasure in them. Attendees at this conference for 22 years have told me that the exhibitors aren't merely advertisers, but they're content too, and we subscribe to that. We take that further because at the conference, we have a select group of people who will present to you who are what we call the living legends. These are the Robert Friedlands and the Ross Beattys of the world, people who have built multi-billion-dollar companies, resource companies, from scratch. Hearing their stories, how they built the companies, and how those experiences have shaped how they invest and how you should invest is really, really, really invaluable, in my estimation. All of this comes together to create a conference that's really stood the test of time. By the way, if you can't come to Boca Raton, we live stream this conference, so you can attend the conference from the comfort of your own home, seated in front of your own computer. Whether or not you attend the conference live or in live stream, you will have access to the conference archives. We record the whole conference, and you'll have access to those archives through the balance of 2023. I know that given the fact that we're going to have 50 hours of live programming in 4 days, that nobody is going to be able to absorb all the information that they pay for. And having the ability to absorb the information again and again and again at your leisure in your own home is invaluable. I'm so convinced of the value proposition, Jordan, that anybody who attends the conference, either live or virtually, and doesn't believe that they got their money's worth can email me and get a full 100% unconditional refund. The financial risk is mine. So I think that's really the value proposition. We've stood the test of time. We spare no expense in bringing great people. We absolutely, positively vet the exhibitors, which are the investment opportunity for you, where the rubber meets the road. We use technology to bring this information back to you time and time and time again. And as if that wasn't enough, we de-risk it financially for you by giving you a full ironclad money-back guarantee.
Well, that's so wonderful, Rick. Thank you so much for coming on today. I mean, really, this was like a snippet of a masterclass for me and all the listeners out. There's really valuable information, and you could get even more if you physically attend the conference or stream it online, as you said. Rick, thanks so much for coming on. And so people can find you at ruleinvestmentmedia.com.
Absolutely. Any of your people who care what I have to say about natural resources are invited to go to ruleinvestmentmedia.com. If you want, list your natural resource stocks. I'll personally rank them 1 to 10, and I'll personally comment on issues where I think my comments might have value.
Okay, on that note, Rick, thanks so much for coming on today. Really appreciate it, and look forward to speaking with you again, and wish you all the best at your conference.
Always a pleasure. Thank you so much. It was a fun interview. I like the work and effort you put into your interviews and the questions that you ask. It's been a pleasure.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.